Hello everyone. Today I'm going to show you how I see my structure, internal range liquidity and entries, how I trade the range cycles. So first of all, we have market structure like this. Okay, so this is what we know about market structure. We have higher highs and higher highs and higher lows in a bullish scenario. So in a bearish scenario, it's the same thing. So a lot of times price would break these laws, and most people would think that prices turn bearish to go down, and then they get trapped. So I'll show you how we see market structure so you don't get trapped. So for me, a valid low is when price takes out liquidity and then goes up. Okay, so this is a low for me. Okay, whatever happens in here, price can do whatever it likes, but when it makes another run on liquidity and break of structure, then this is what I consider as a range. Okay, so ideally, when price is in a bullish structure, this is how I see it. So we have a lower low, then price makes a higher high when it runs liquidity and breaks structure. So for me, here when it took out this liquidity and it broke out structure is my low. Then when it runs liquidity and breaks structure, that's my high. Okay, so when price comes back in here to take out this, it does not mean that price is now bearish. No, this only means that price is taking internal range liquidity to then go up. Okay, so this is what I see when we talk about a bullish structure. Okay, so this leg has internal range liquidity, which is this that I marked here. So when price comes down, too many people start selling because they think that after taking this liquidity, price is now in a bearish range. So you need to define your trend. So if price is trending up, like I said, you need price to run on liquidity. Then in the range, price will create liquidity. Once it takes liquidity and breaks structure, that's when we say the price is pulling back on that particular leg. For example, if this is the H1 leg, then this internal range liquidity is lower time frame structure. So after this, I confirm my higher low here and higher high. So price is about to make its higher low like this, then continue up. Okay, so this will be my higher low, and then I target my external range liquidity like this. Okay, so in this scenario, this is called internal range liquidity. Okay, all of this is called internal range liquidity. Internal range liquidity needs to be taken before price takes out external range liquidity. Okay, like that. So price will take internal range liquidity to external range liquidity. So this is what we call a range cycle. So when price finishes taking all the internal range liquidity, it will go for external range liquidity. So basically, this is how market structure is viewed with this strategy. So now, combining both, we say price needs to run liquidity to create a low and then break structure. Then it will create internal range liquidity. So when price is ready to make a pullback, it will create a break of structure, a run on liquidity, and a break of structure. Then it comes down to take all the internal range liquidity. After it's done, it will then come for the external range liquidity, like that. Notice something. When price is going up, it creates liquidity. And when it's coming down as well, it creates liquidity. Why does this happen? Because most people try to buy here, because price is making higher highs and higher lows. Okay? So price is making higher highs, higher lows. So this is how people view structure. So people try to buy here, then they get stopped out. Then they try again to buy somewhere here, they get stopped out. They try again to buy somewhere here. After they're tired of being stopped out, people think, it's a bearish range. Then they start trying to sell here. And they get stopped out. Here again, they get stopped out. Then they change their bias again and continue getting stopped out. So this is what happens now. Smart money traders usually buy here. If you notice, every time you buy here, you might be in profit for a couple of hours or a couple of minutes, but price will continue down and take you out. Usually smart money traders say this is a demand zone. After that, they go to this zone and put their buys here. Same thing happens. Okay, then the reverse will happen and people will get stopped out. So price needs to come into internal range liquidity, then go to external range liquidity. That's our range. So I'll show you an example of the trade I took yesterday. This is Euro USD on the 15th of February 2024. So this was my range from here to here. Okay, we have price moving like that, our run on liquidity here, and our break of structure here. That created our low. Okay, then price then moved up like this, like that, and that. Then it took this liquidity and broke structure here. Okay, so that then confirmed this high. So this was my range. Okay, this was my range, which is marked by these dots. So price was going to come for internal range liquidity. So after taking out this one, price then came for this as internal range liquidity and also this as internal range liquidity. If I mark my chart here, that was also internal range liquidity. So when price completed this internal range liquidity, it was going for the external range liquidity. So now, as you can see here, price then broke structure, ran liquidity, broke structure. So when price is returning down, it's supposed to create, it's supposed to take out internal range liquidity of this range. Let's just say the red range. It's supposed to create internal range liquidity for us to confirm a buy here. But as you can see, there is no internal range liquidity here. This is a trap for the smart money buyers. So usually people would say this is a demand zone and they'll try to buy here on the demand zone. But to me, this is a trap. Why? Because we don't have internal range liquidity. So if this is a trap, it means just below it is where people are putting their stop losses. That's where we enter. Okay, you look for your order block, for your key levels, then you enter right below that. Okay, enter right below that with your stop loss just here. Okay, then you target external range liquidity. All right, but I didn't enter from there because I was not on the chart at that time. So then what did price do? Price then gave us an entry and then it broke this level. After breaking this level, I marked my low here and my high here. As you can see, we have our run on liquidity and our break of structure, and our run on liquidity and our break of structure. Okay, so when price does not have internal range liquidity, there is no internal range liquidity here, this is most likely a smart money trap. Okay, so for it to be valid and so we can buy here, we need price to generate liquidity. So what do I mean by this? If price is coming to a zone, there is no internal range liquidity here, and price is coming to a zone. If you buy it like that, it's just going to react and take you out. Okay? So for you to validate this zone, price needs to create an inducement. It will just come to the zone and not tap it and go up. Then what do? People start buying from this zone, thinking it will go up, yet it's creating inducement for this low. Price will then take it and go up. All right. So now, this is the scenario that we had yesterday. Price didn't have internal range liquidity. It then generated inducement above our zone. Then when it was going up, guess what? People are starting to buy here on this zone. But what did we say? What did we say about smart money traps? This is a trap. Okay? Then our entry is just below the trap. As you can see, this entry is the same with this entry. Notice, there is no internal range liquidity here. Okay? Then this is a trap. Price broke and then went up. Okay? This is the same thing that happened here. There is no internal range liquidity. People try to buy here, price breaks and then goes. Okay, so that's how you could have caught this trade and targeted this external range liquidity. So this is just how we play the range cycle. You could have caught a sell here. Look at this. We have a range, run on liquidity, break structure here. We have a range from here, and run on liquidity here, break structure here. We have a range. So from this high to this low, we have a range. And where is our internal range liquidity? Our internal range liquidity is sitting right here. This is our internal range liquidity. Okay, so price will take all the internal range liquidity if you had put your entry here on this block. See? So if this is our internal range liquidity, where is our external range liquidity? It's right here. This will become our external range liquidity of this range. It's our external range liquidity of this range. So you could have placed your sell here and a stop loss there, and your target profit on your external range liquidity. Okay, so this is how you catch sells and buys in a range. That's why at times you'd buy and sell in the same range. So if you understand how the range cycle works, you'll be able to make profits from both sides. So I hope this video has helped someone, and like and subscribe. Thanks.